Today, we will talk about franked dividend, definition, types, example. A franked dividend in Australia eliminates the double taxation of dividends. It allows shareholders to reduce the tax paid on the dividend by an amount equal to the tax imputation credits. It's important to understand that an individual's marginal tax rate and the tax rate for the company issuing the dividend affect how much tax an individual owes on a dividend. Franked dividends are paid with a tax credit attached, aiming to eliminate the issue of double taxation of dividends for investors. Dividends are paid by companies to their shareholders out of profits, and these payments are often periodic. Since the payments are drawn from profits, it implies dividends have already been subject to tax at the corporate level. So, a shareholder receiving the dividend should not be obligated to pay taxes on that dividend when it comes to paying their individual income taxes. Franked dividends eliminate this double taxation by giving investors a tax credit, commonly known as a franking credit, for the amount of tax the business paid on that dividend. Franked dividends can be fully franked or partially franked, less than 100%. There are two different types of franked dividends, fully franked and partially franked. When a stock's shares are fully franked, the company pays tax on the entire dividend, and investors receive 100% of the tax paid on the dividend as franking credits. In contrast, shares that are not fully franked may result in tax payments for investors. In the case of partially franked dividends, a tax credit is attached to part of the dividend, making that portion franked, and the investor is responsible for paying the remaining tax balance. The tax advantages of franked dividends for investors are apparent, but there are additional benefits for markets and society. Double taxation deters investment in publicly traded companies that issue dividends, and it distorts investment choices, potentially leading to reduced economic efficiency and lower incomes. Franked dividends help to create more stable and competitive markets by lowering the tax burden on dividends. From April 2016 to June 2019, New York-based investment firm Van Eck ran the Van Eck Vectors S&P ASX Franked Dividend ETF, which tracked the S&P ASX Franked Dividend Index and included companies in the S&P ASX 200 that paid out 100% franked dividends in the preceding 2 years. The fund changed its investment objective and name in June 2019. Here are 4 key takeaways. 1. A franked dividend is paid with a tax credit attached and is designed to eliminate the issue of double taxation of dividends for investors. 2. The shareholder submits the dividend income plus the franking credit as income but will only be taxed on the dividend portion. 3. Franked dividends can be fully franked or partially franked. 4. Franked dividends help to create more stable and competitive markets by lowering the tax burden on dividends. Hope this would help. Thanks for watching.